Hi, good evening, everyone. Welcome back to the channel. So we have a special guest on this evening, Austin Graff of Opal Capital. So Austin, thank you so much for coming on. Do you want to just introduce yourself to the audience?
Thanks for having me. I'm the CIO of Opal Capital, which is we basically have two main business lines. One of them being dividend-oriented investing, which is what we're here to talk about today. And then we also do an outsourced chief investment officer business where we manage portfolios for individual clients.
Okay, so I saw that you have your CFA and MBA, and that's really impressive. I definitely want to talk to you about the CFA. I have my MBA as well, but no CFA. So how did you find that as far as getting the CFA, and what's been your experience as a CFA?
Yeah, so the CFA was an interesting journey. I was a 3+2 student, meaning you get your BA and MBA in
Oh,
5
yeah.
years. And
Mhm.
so that allowed me in the fifth year when I was in business school to take the first two levels of the CFA. And that was back at a time when you could only take level 2 and 3 one time a year, and you could only take level 1 twice a year. So took level 1 in December and level 2 in June. Passed the first two levels, and then I went into the work environment, and it took me, gosh, probably 4 years until I took level 3. And it's much easier to take the first two levels when you're still in study mode,
Yeah.
still in school, because a lot of the content outside of some of the ethics stuff is pretty consistent with what you learn in school. And then level 3 was very difficult for me, mainly because I'm more of a quantitative individual, but also because I was working as a investment banker at the same time. So trying to slip in studying on weekends and nights where I didn't have to work too late.
Awesome. Yeah, I've been there myself. I probably should have studied for the CFA while I was in school. Like you said, study mode. I'm kind of out of that for like a year now.
Okay.
Yeah.
Yeah, it's much more complicated. We have a guy on the team who is studying for level 3 right now, and he keeps telling me how difficult it is
Yeah.
just to find time. So I think when you're in that mode of allocating time to studying, it's a bit more convenient, but otherwise you got to schedule it and just make sure you get after it like anything else.
Right. Would you recommend after being out of school for a couple of years to still pursue it?
Yeah, for me, it was a career change. So
Yeah.
I started investment banking, focused on infrastructure at first, and then financial institutions. And getting the CFA was a real impetus to kind of get out in the job market and start looking for opportunities that were not as much on the sell side and more on the buy side.
Hmm.
And it was a good. What I tell people is it's a good demonstration of your commitment to the business, right? Like if nothing else, it's a commitment of time to actually put in the time and the dedication to get to pass the three exams. And if you can do that, it shows that you're willing to go a lot further than most people to get up to speed on the curriculum. So, especially people who are looking to maybe advance in the field that aren't necessarily willing to go back to business school, or you have that MBA and you're saying, "Hey, I want that job as like a security analyst or as a portfolio manager." That the CFA is a great indication of kind of the commitment that you can put in.
Yeah. I definitely agree. If I was to like quit my job now, I definitely would like to get the CFA one day, but I know it's a big commitment.
For sure.
So as far as your firm, do you guys offer any funds?
Yeah, so we have an ETF called the Opal Dividend Income Fund. The ticker is DIVZ.
Okay.
And so this particular ETF focuses on 25 to 35 US dividend paying equities.
Hmm.
And so it's a concentrated dividend portfolio that, you know, we kind of say the differentiator between us and many of there's a lot of passive options out there.
Hmm.
But the passive options tend to be kind of one of two flavors. They either tend to be a low yielding dividend growth fund or a high yielding fund that, has variable dividend The low yielding dividend growth fund tends to not have a lot of income today, but it's going to grow at 10+% a year. And in year 10, your yield on cost looks amazing. In reality, most people don't stick around with a fund for 10 years, so it's kind of a useless number.
Hmm.
The high yielding funds tend to be in a lot of value traps because they tend to be overly cyclical names that are overpaying on their yields. And so what we are putting together with DIBZ is an attractive yield today that's also growing over time. And we utilize fundamental analysis, analyzing free cash flow and capital structure to make sure that the companies not only have the ability and willingness to pay, but have the ability and willingness to grow over the coming years.
Interesting. So what I see here, I'm actually looking at your fund now. It looks like you guys have been around since 2021. Is that correct?
Yeah, so the strategy's been around since 2020. We launched a dividend in January 21.
Okay.
And then just 2 or 3 months ago, we started paying a monthly dividend, which was previously quarterly.
I see that.
Um,
Yep.
yeah, it's making the numbers look a little skewed right now, but quite frankly, monthly dividends are better for investors because they more appropriately match up the dividend payment with the actual AUM in the fund.
Hmm.
We managed $5 billion in dividend paying funds at Pimco, and that was in the mutual fund space. Uh, the mutual fund space is much harder to pay monthly. So some of that was that institutional creep that led us to launch this with a quarterly dividend. And then we realized that we needed to make an adjustment and recently did that to get to monthly.
So it looks like your monthly dividends, if I add these up, these are just about the same right now as what the quarterly one was before, maybe
Yeah,
more.
so the
Yeah.
yield on the portfolio is between like 3.5% and 4%. You should expect the yield on the underlying fund to be somewhere in the 3.25% to 3.5% range
Hmm.
after the fee. Then we expect, on average, that dividend to grow in the mid to high single digits a year. And that's based on the underlying holdings that we own. We tend to own names that are growing in the, call it, 6 to 10% range, but it's a blend, right? So we have some lower yielding names today that have really aggressive growth rates, and then we have some more bond-like equities that don't have much growth but are paying attractive yields today and have plenty of free cash flow to do so.
Okay. So I see since the fund's been around, it's got like a 22% total rate of return, and it's paying about a 2% dividend.
The 2% is a little misleading because it's a conversion to monthly from quarterly. So
Right.
once we lap that entire call it monthly issue,
Hmm.
it'll show up as being a better than 3% yield.
Okay. So this is more like you said, a dividend growth fund. It's not definitely
It,
not like a high dividend yield, but it's more stable as far as the growth.
Yeah, for sure. It's not going to be so. There's some covered call strategies out there that are paying 10+%.
Hmm.
That's not what we're doing. If we wanted to optimize for yield, we could. We feel in those cases you're giving up quite a bit on capital appreciation. So we've looked at launching covered call strategies. Quite frankly, a lot of these more conservative names don't have the most premium in the calls right now.
Hmm.
So you could probably add an additional kind of 1 to 3% in yield, but you're giving up quite a bit on upside because when those performers get called away, it can be painful. One of the things to keep in mind in active management is usually you have, call it, 3 or 4 names that carry a lot of the water over a short period of time. And if you've got calls written on those names, it could end up creating, it could end up hurting you from a performance perspective. There's always the option to rebuy the names after they get called away, but it creates a lot of transaction costs and noise. So it's just something that we've looked at. It there's a lot of action in the space right now. Not something that we want to get involved with when there's so many others that are, it seems like, already executing there.
Yeah. So I cover a lot of high dividend funds and this channel. Yield Max is like the main one. I'm sure you've heard of them. They're
Yeah,
paying like 50% plus on some of these. But
yeah.
The nav is eroding on several of them, like especially Tesla.
Yeah, it's like, so it's kind of like like mortgage REITs and BDCs, right? Like they'll pay out 10, 12% dividends, which obviously isn't 50%. But then you turn around in 6 or 12 months and you got a 10% yield, but the price went down by 8%. And you're
Hmm.
like, what the heck? That's not that attractive.
Yeah.
Unless your sole objective is to optimize like how much income you're getting. And so this is a more traditional stock fund that's meant to be held for the long term. I feel like some of those call strategies on some of the Mag 7 names, um, they're probably shorter term in nature. They're really benefiting from the fact that the market's so excited about these names continuing to go up, which is creating an abnormally high rate of premium on some of these calls that are written. Um, it's I think it's more of a short-term phenomenon, to be honest with you. As long as the S&P has like 30% of the market cap in a handful of names, you're going to see that continue to work. But once those stocks, no longer are considered kind of one-way stocks, that premium might dissipate a little bit, and it might not be as exciting.
So I'm looking here. It looks like it's pretty balanced as far as the holdings.
Yeah, it's a little less balanced than traditional active.
Hmm.
So I kind of think of traditional active as being the Noah's Ark approach to investing, where the manager buys like two of everything, and they end up with 50 to 100 names in a portfolio.
Hmm.
We don't think that adds a lot of value in a time when you can buy an index for 2 basis points or whatever it is today.
Right.
And so we're trying to take active plays in areas that we think we see true opportunity. So, for example, 17.3% energy, that's relatively high, right? The benchmark's considerably
Hmm.
lower than that. We think there's a lot of value in energy today. We also think there's a lot of value in uh, semiconductor names that aren't named NVIDIA,
Hmm.
mainly because uh, we think that there's just other players in that ecosystem that aren't priced like NVIDIA that can still benefit. So like we have a position in TSMC, we own Qualcomm, own Broadcom, we even own Oracle, which isn't a semi name, but that's an AI beneficiary.
Yep.
And then another area that we have a relatively high allocation is in utilities. And this is again a part of that AI play. These aren't the as much the merchant utilities that you see just exploding on the index right now, right? Like they're the number one performers year to date, or top five performers year to date, maybe
Hmm.
slightly behind Nvidia. We own a couple of regulated names, and then one merchant name that is trading at about 9 times earnings, which we think is a good buy right now, but time will tell.
So I see you're in Citi. That's you probably are thinking that's undervalued based on the stock.
Yeah, so the flavor of value that we pursue, and I think it's tough because the traditional, or I don't, maybe not traditional, but most people when they think of value, they think just buy cheap stocks, right?
Hmm.
Almost like the dimensional fund like approach. Just give me cheap price and everything else will work out. And we're not trying to do that. We're saying, like, hey, we're looking for companies that are attractively priced, but also have solid fundamentals. And we think what Jane Fraser is doing at Citi could definitely lead to some solid fundamental growth in both earnings and free cash flow. And the current capital position is relatively strong. So with the valuation, it just seems stupid cheap. Quite frankly, it was a bigger position. It grew to over 5%, and then for regulatory reasons, we had to sell it down and give ourselves some room because you can't. There's a rule you can't own more than 5% in a 40 Act fund of a company that I guess sells or underwrites securities as one of its main lines of business.
Hmm. Yeah, I agree with you 100%. That's why I'm also in Citi. And if it could just get to where like one of its peers, JP Morgan Chase, it's got huge upside.
You don't even need it to get there. I mean, if it gets back to like 1 to 1.25 book value, everyone's going to be super happy, right? And so as we see the returns on invested capital improve, we see the capital base improve, and they cut out layers of management. Like it seems like it should get there, but I think that there are portfolio managers and analysts that have come along every few years for the last decade thinking that this CEO has the answer and they've been wrong. So I'm a little hesitant to just say like absolutely Fraser's figured it out and there are no issues. But I think that the pieces are there and she seems to be doing a pretty good job of putting them together so far.
Hmm. Yep. So I see you mentioned Oracle. I've also been invested in that one before too. It sounds like you're actually looking at possibly undervalued plays similar to the peer group, like you mentioned NVIDIA for like for AI and for chips.
Oracle's really interesting right now because of that AI play.
Hmm.
Um, they're finally getting traction in an area that historically people have thought they couldn't get traction. And so the most recent kind of earnings call or two, they've demonstrated that growth in AI is really starting to accelerate. And one of the things that they're talking about is the uniqueness that they have is they can their data center AI data center technology has the ability to scale as on a modular basis. So they could build a data center on a submarine or a cruise ship just as they could build a massive data center in Virginia. And I think that's a
Interesting.
differentiator, especially when you think about energy demand from data centers and
Hmm.
think about, data centers building where the energy is. If you could build a small data center off a wind farm, that could be an interesting technology that isn't necessarily widely talked about right now.
That's very interesting, and that's something that Oracle is kind of uniquely doing.
Right.
Yeah, awesome. Okay, so let's see. Okay, so you've got one ETF. Do you have other ones in the works?
Yeah, we do. We're
Sure.
we so the team, myself and Adam Mueller, uh, we were global portfolio managers and analysts at Pimco, and so
Hmm.
this is the U.S. Flavor, but we've got an international version that we're also focused on, with both of our backgrounds being more global in nature. And it like there's the side of things that from a dividend yield perspective, the dividend culture in the US is not nearly what it is globally. So we could put together a very similar fund to what we have here in the US with called a 3.25 to 3.5% dividend yield. And it would have a 5 to 5.5% dividend yield just because there's a more sound or supportive dividend culture in other parts of the world.
Hmm. So more so, like, would you say for the high yield or for dividend growth?
We would take the same philosophy and approach, but we would just be starting with a higher yield because of the dividend culture globally. So if you were to look at call it financial institutions in Europe, where in the US right now a high yielding bank or money center bank might be 3% to 2%, you can get a 5 or 6% dividend yield from a European bank right now, and that's pretty consistent across the board regardless of the sector that you're looking at. It's just a different mentality. We always loved when we were managing global funds to be able to offer a much higher yield because you can find companies that have it ingrained in their culture to pay dividends rather than focusing on buybacks, which is a very US kind of centric phenomenon.
Hmm. Interesting. So you said Pimco. I've actually talked to some other fund managers at other companies that were at Pimco as well, and I do have a really high opinion of Pimco and their investments. So I think it was the Curve people, actually. I don't know if you know
Okay.
them. Yeah.
Yeah, simplify.
Simplify, I think some of them also, and some of the Curve investments people.
Okay.
Yeah. Okay, so you said you guys started in 2020 and your first ETF went public in January 21, right?
Right.
Okay. So what kind of led you all to start your own firm?
Yeah, it's interesting. We worked for a large asset manager that was managing mutual funds, and quite frankly, I was relatively young as a PM, and thought that there might be a better way to do this that was a bit more linked to underlying investors rather than just focusing on kind of the corporate bottom line.
Hmm.
And so I left Pimco kind of thinking I would work with RIAs, but not really knowing how I would do that. And so I started working with an RIA in Texas and started running SMAs for them. And that's how our first SMA started, a separately managed account that's focused on dividend paying equities. And then another advisor who I was close with reached out and said, "Hey, I'd really love for you to run an ETF." And I thought it was nonsense because this was before there were many active ETFs. I thought
Yeah.
that it was just, that ETFs were for passive investments. And so I kind of, pushed him off and didn't pay attention. And eventually he said, "Hey, how much would it take for you to launch an ETF with this strategy?" And so I threw out some high number again, expecting him to like go away. And
Hmm.
he came back and he said, "Listen, if you launch an ETF, I'll commit to putting 20 to 30 million in."
Nice.
And so that was what it took to kind of get off the ground. I wouldn't advise anyone to launch an ETF unless you have a supportive investor that's going to be able to put 20 to 30 million in, because otherwise you're just signing up for uh, a lot of money flowing out of your pocket.
Yeah.
And so I think one thing to keep in mind is, and I didn't realize any of this. I had to learn the ETF space once he came to me and said, "Hey, this is what I want to do." And the more I learned, the more I realized that this was actually what I was looking for. The active ETF structure is a way to provide retail investors that transparency, that low fee option, and the tax benefits that is usually reserved for institutions.
Hmm.
And the more I learned, the more I like got into um, thinking that this is a great opportunity, and then that led to saying, "Hey, more retail investors should be using ETFs." Like, there's still this thought process that ETFs are like passive and only index oriented, and so that's why we created the OCIO business, so then we could put together tax efficient portfolios for clients that utilize both active and passive ETFs. And as we've kind of gone through this, we've realized like all the different benefits, and I'm sure you guys are aware of that if you focused at all on ETFs, but they're way
Absolutely.
more efficient than mutual funds, and so it all kind of like worked out, but it hasn't been a straight line.
Yeah. No, that's funny because I remember when I first heard of an ETF, I kind of thought the same thing. I used to work for advisors myself, and they used mostly mutual funds, but the retail ones with the really high cost. And now I personally see ETFs being much more efficient and much better than mutual funds. And from a cost standpoint, from an expense ratio standpoint, obviously much lower.
It's much better for investors, but keep in mind, if you're an aspiring ETF manager and you want to launch your ETF,
Hmm.
there's a lot of fixed costs in the ETF space
Yeah.
that are not covered by investors. You literally have to get AUM up to a certain level before you cover those fixed costs. It's different from the mutual fund space, where in the mutual fund space, as long as your fee doesn't look so absurd that people won't buy it,
Hmm.
the fee actually, or the fixed costs actually flow through to the investor.
Yeah. Well, compared to mutual funds, I mean, I've seen mutual funds with like a 4% like sales charge
Oh
and
yeah,
then the annual charge as well. With mutual or with ETFs, I think the highest I've seen might be less than 2%.
yeah, and I think that's really unique. Like, we see a lot of individual retail accounts with this OCIO business, and honestly, there's a lot of products that probably shouldn't be sold to clients.
Hmm.
I think if mutual funds were to be created today, the SEC would shoot it down because it just doesn't make sense.
Yeah.
But you have all these legacy fund companies that are out there, and they've got sticky businesses, and they've got a lot of money for lobbying, and so they're not just going to shut down the business; they're going to let it kind of dwindle away. And
Hmm.
so I think it's unique. And when we launched DIVZ, the big debate was, will any active managers actually make their portfolios fully transparent?
Hmm.
Because the legacy institutional managers were like, my asset selection is intellectual property that if I give it away on a daily basis, people are going to steal it, and that doesn't work for me. I think a lot of that was posturing in order to try to keep their cash cows. And we've seen over the last year or two a number of firms make that transition from the mutual fund space to ETFs, where you look at Capital Group now. They're trying to do it in a way that doesn't cannibalize their main business, but they're adding assets pretty quickly. DFA actually just converted a bunch of mutual funds to ETFs. So there's definitely some institutions that are realizing they have to get involved. And you look like JP Morgan is, I think, the largest active ETF manager out there with products like JEPI, which you've probably looked at,
Oh
given
yeah, I hold some.
your
Yep.
your focus. We
Hmm.
have it. We have it in our OCIO portfolios as well.
Nice. So explain your OCIO service briefly.
Yeah, so we partner with financial advisors, and basically, how you think of it is financial advisors tend to be that forward-facing relationship with advisors. They tend to do a lot of planning, but they may not have as much experience on the back end from an investment perspective or an operations perspective. And so we combine uh, investments, operations, coaching to advisors, and then we allow them to focus on what they're good at, which tends to be reaching out to clients and helping them with planning. And so right now we have about 750 million in an OCIO business that tends to be either ETF portfolios or custom solutions for larger clients. So typically, if a client has $1.5 million plus in investable assets, we'll customize a solution based off their underlying needs. If they have less than $1.5 million, we work with advisors to understand what their planning process is. And then we come up with portfolios for each part of their planning process. So a lot of advisors will have like a short-term allocation, an intermediate allocation, and a long-term allocation. And so we'll come up with a portfolio for short-term, a portfolio for long-term, or for intermediate term. And then generally we have two long-term portfolios, one for aggressive and one for conservative based on the risk profile of the underlying client. Historically, there's been this desire to just place everyone in a 60-40 portfolio. And then 2022 came along and everyone's like, whoa, this doesn't really work. Because, bonds and equities went down. And so we basically said, hey, there's got to be a better way. Obviously, being equity income managers, we looked at 2022 and we said, hey, dividends are cheap, fixed income is really expensive. Put your money in dividends, not in fixed income. Our portfolios did really well in 22, and that was a tremendous tailwind for this business. But that's not going to work forever. And so what we've done is we've said, hey, traditional 60-40 doesn't make sense for everyone. Instead, let's try to more accurately get your mix between fixed income and equities based on your current financial situation rather than some like rule of thumb. In investing, if there's a rule of thumb, it's more likely than not that it's wrong.
Yeah.
And you should probably dig in and figure out what's going on there. And so we've actually been pretty successful at finding some of those kind of market, like I would say market rule of thumbs, and digging in and figuring out where it's broken and then finding ways to improve upon them.
Awesome. So you might have said this already, but your net worth threshold for the individual client solutions.
Yeah, so individual SMAs, so there's two types of SMAs. So one, if we just run a dividend SMA for you, the minimum on that is 250,000.
Oh, okay.
And then there's allocation accounts that we do for us to customize an allocation account for you. It tends to be clients with 1.5 million or more of investable assets. And that just has to do with the fact that we're putting it into generally about 10 different funds, and we want to make sure that we're appropriately diversified.
Okay. Interesting. Let's do some audience questions here. So this is one of my co-hosts on the podcast. The other guy wasn't available till 7, so we'll have to reschedule that. But anyway, he said, do you attempt to factor in the competitiveness of the business model, or do you primarily focus on margins and returns? Also, do you favor free cash flow or net income?
So second one first, we favor free cash flow. The first one, we look at all of the above, to be honest with you. We focus on margins and returns, but business model is really important. One of the things in dividend investing you learn pretty quickly is follow the cash. And so we tend to try to follow the cash, not just in the company, but also through the sectors. And so if you think about a good one is, let's look at AI, right? If you just wanted to go pick the companies that are mentioning AI the most in their earnings transcripts or earnings releases, you'd go buy Microsoft, you'd buy Google, you'd buy Meta, and you'd probably be fine. But if you really think about where the cash is going, these guys are all spending tens of billions of dollars to build out AI data centers. It's unclear today how that generates any incremental cash flow, but we do know who's going to generate cash flow from that money that's being spent. And it goes back to like the picks and the axes from, or the picks and shovels from the gold, the gold mining era that's often referenced. So you're
Mm-hmm.
looking at the equipment providers that are supporting the build outs of these data centers, and also the energy providers that if the data center gets up to operating, they're going to be generating a lot of cash flow. When we look at industries, when we look at companies, we try to figure out not just like where the hot trend is, but where's the cash flowing based on this hot trend, because that's going to be what drives dividends and dividend growth.
Mm-hmm. So I might have asked this already, but would you consider a high yield fund?
You're saying a high yield dividend fund?
Yeah.
We've had clients ask us to do this, and
Mm-hmm.
I would do it in a separate account, but I don't think I would do it in a public fund structure, just because I think people can often be misled by the it can often be misleading when they see this big high yield and they go buy it, and then they see the principal come down and they get really upset with someone. The person they're going to get upset with is me.
Yeah.
And so I want to be able to have a conversation with everyone who's buying that fund, so I make sure they understand the risks. Now, we've seen in divs, we've seen a lot of baby boomers
Mm-hmm.
who are interested in owning something like divs because it gives them a nice yield today that's also growing over time, and it's got that inflationary component. As they've been kind of through this inflation fear of the last few years, they look to something like divs as being like a great balancer for that. But you know I don't necessarily want to get into the business of providing just a super high, like I could do it. My background is I did financial institutions and infrastructure at Goldman, and then
Oh,
I
okay.
focused on a lot of alternative financial vehicles when I was at Pimco. So I looked at a lot of BDCs, MLPs, REITs, and I focused on a lot of the higher yielding parts of Pimco used to call them the shadow banking system, but
Mm.
higher yielding parts of the market. And it's something that, it's kind of second nature for me, but I wouldn't want necessarily my reputation to be out there on a public fund that is bringing in assets based on some yield number that might be at risk due to, principal, like changes in the underlying principal balance. So um, it's one of those. I do it with some separately managed accounts, but it's not something I'm super excited to start a fund for.
Okay. So this is your team here. This is you, and then
That's the team, yeah.
yeah.
So you got myself, you've got Adam Mueller, who he and I have worked together at Goldman, at Pimco, now at Opal, almost 20 years.
Oh well.
We've worked together. Jay Coulter, you might know him as a resilient advisor. He's got one of the first podcasts that was ever geared towards financial advisors. He does a lot of work on the coaching side for us. So helping advisors make their practices more efficient while also helping us communicate
Mm-hmm.
with different clients. We've got if you go down a little bit, you've got Keith Wagner, He's another industry veteran. He's been at some big institutions like Neuberger Berman and Allianz. He helps out with distribution and strategic relationships. And then we have our marketing and support team.
Okay. I saw Keith's name on the live stream, actually. Was he wanting to join in?
Yeah, he often has different thoughts on what I should be commenting on because
Oh,
he's like the tip of the spear for us. He's the one that's out in front of all of our clients and hearing the messages that they like to hear.
yeah. Okay. Yeah, if he wants to join, he's welcome to. I see his name here. Um, but yeah, or we can keep going.
Let's keep going.
Okay. So let's see. What else do we have? Yeah, I just really just found out about you guys from the email. Yeah, I appreciate you all reaching out. I was actually just, I don't know if you all saw, but I was on the New York Stock Exchange about a week ago.
Oh
Um,
yeah,
yeah, so I've
we're
noticed, huh?
we're gonna be on FinTech TV in the morning. So if anyone
Oh,
wants to
cool.
tune in to FinTech TV, which is the New York Stock Exchange little TV program that they do.
Nice. Yeah, I like fintech. Let's see what else. So you definitely have more ETFs in the works. Every fund manager that I ask always says yes to that. Everybody's always got some more ETFs in the works.
Yeah, I mean it's like I think that everyone aspires to have more, but um, it's not often a real. So getting to the first 100 million for a small ETF manager is really hard.
Hmm.
And so you basically, depending on your fee level, you got to get to 30 million to be profitable at the vehicle. And then you got to get to 50 for people to even look at you. And at 100, you can start getting onto platforms. And so it's a lot of small, like bigger firms, yeah, fine. Like you just go launch, you put everything out there, and some stuff's going to work, some things aren't going to work, and the things that work make up for everything that doesn't work. I mean,
Hmm.
that's kind of the Pimco approach too. As a smaller firm, you got to figure out what your resources are and where you should be allocating those resources. So you have to kind of phase it more appropriately and identify, what the right, you know, chronology is there. Obviously, if we were bigger, we could probably launch a few more funds, but it doesn't make sense. You've got two seasoned portfolio managers who are looking. I mean, international is a pretty big lift for us because there's literally 8,000 stocks that we could buy, and so it's a pretty big effort to narrow that down to 30 or 40 names.
Hmm. Interesting. One interesting point about the mutual fund versus ETF discussion. I won't say what company it was, but where I worked before, they have a large cap mutual fund that has drastically underperformed. Like what, as far as what large cap has done over the last 5 years, like you wouldn't believe. I'll give you the ticker offline, but it has drastically underperformed. I mean, it's insane.
There's a lot. So there are a lot of value managers who are stuck in this value vortex and they have just gotten crushed for a decade plus.
Hmm.
And it really goes to show that there are some managers who are able to adapt and adjust to the environment. And there are some managers who just stick to the same old dogmatic processes and refuse to change. And they basically say, hey, at some point, the market's going to come my way. But money management is one of the most competitive businesses there is. Like
Yeah.
you get judged on a daily basis or pretty much daily basis. I think tomorrow's a half day or something like that. But pretty much
Yeah.
every
Yeah.
day they judge you. They tell you, did you do good or did you do bad? Right. And so for you to sit there and say, hey, I'm getting judged daily, but next year is going to be better. And then you get another year. Oh, sorry, that was 2 bad years. Next year is going to be better. At some point, you have to sit back and say, all right, am I doing the right thing for my clients here? And I feel like a lot of the legacy value managers that have significant um, assets under management have just kind of stuck their head in the sand and they're doing themselves and their clients a huge disfavor. And see, it's not coming up with a new a definition of value, but it's like, hey, maybe I should be thinking about value from a different position.
Right.
We're not out here buying the most expensive names in the market, but we did tie a quality component to our process, and we added in a growth component to the process, because if you're just buying cheap things that are declining in, or have a declining revenue and earnings profile, those cheap things will become expensive over time, right? And the idea is to find things that are attractively priced today, but will become cheap over time if they just continue on the current process. And so I would say that was a big change that Adam and I had to learn when we left Pimco and started out with Opal. We had to come. We basically, people say like, "What are you doing different than everyone else?" And I would say what we're doing different is we're combining some of the value component that we knew from being, institutional managers at Pimco, with a growth and quality component that we've had to develop and adapt, because for the last decade, if you didn't have a quality and growth component in your process, you look like an idiot, right? And
Hmm.
you probably lost your job and you have no assets. And those two things happened either in that order or an inverse order, but that's what's happening to most strictly value managers. Like, you can't go out and pick nets anymore like Buffett did back in the 50s. It doesn't work. Buffett's had to adapt like 5 different times over the course of his career. And then you have a lot of traditional value managers who refuse to adapt. I think it's kind of a closed mind perspective.
Hmm. So my last question, how have you found like the outreach on social media to different channels, different outlets? Have you found that interesting?
I'm like a Luddite when it comes to social media. You could
Yeah.
look at all of my social media, and I think the maximum amount of like exposure you would see is on LinkedIn, and that was because I felt like I had to.
Yeah.
And so for me, it's like learning the platforms from the ground up. I actually spend much more time reading what I consider durable information
Hmm.
rather than consuming kind of uh, information that has a shorter expiration. I feel like a lot of social media is information that has a slightly shorter expiration. And so I haven't spent a lot of time consuming social media, which puts me in a weird position where I'm often like reaching out to folks like you and participating in some of these mediums, which has forced me to kind of come full circle and start to consume and see what other people are doing. So it's kind of a cool experience, not because I've been consuming social media for the last 10 years, but because, in order to build a business today, you have to be involved with social media in one way or another. And so it's, again, trying to learn how that works and how we can participate and get involved and be an active contributor that's adding value.
Yeah, I notice a lot of fund managers really starting to catch on to the social media game. And I had the same thought process as you a few years ago, but then I started to see like what was sort of being left on the table. But my biggest frustration, and I'm sure you'll notice this too, because you're well educated, so am I. But social media is like a very, very level playing field where there can be, and there are plenty of channels with no background in finance whatsoever. There's channels that have never invested a day in their life until they just wake up one day and they start a channel and decide they're a guru, and then they start investing, and then they take off, you know? So you'll find a lot of that, I think.
I look at like the roaring kitty sensation, right?
Yeah.
And you
Yeah.
can get like, and it comes back to like mindset, right? You can get frustrated from people doing stupid things, right? And that's like, I feel like that's like the 80-year-old approach of like just getting frustrated because like stuff isn't going their way. Or
Hmm.
you can look at it and you say, hey, there's an opportunity here.
Yeah.
And so I think it's more productive to say, hey, what's the opportunity? And, I think, Bill Gross has been really good at this, is saying, you know what, I'm going to go short GameStop or whatever. Like, he's taken this as an opportunity to, you know, play his cards in the market based on what he's seeing, rather than being like some old grumpy curmudgeon that says like, oh, these are idiots and like they don't know what they're talking about. So I think there's an interesting aspect of that. But yeah, I don't know. I find it very fascinating that, you could study and work at this for decades and maybe be able to earn a marginal benefit over the market, and then you have people that wake up in the morning and they think they figured it out because it's like a casino. At some point that doesn't end well, but who am I to be the one that tells them that they shouldn't be doing it?
Yeah, for sure. Okay, well, that was a good discussion. I think we'll end it there. Thanks for coming on. We'll book you on the podcast probably next week.
Sounds good. Thank
Yeah.
you.
And thanks everyone. Like, comment, and subscribe. Check out his website. Check out their fund. More to come. And join Discord, and we'll see you all soon. Thanks. All right, I'm going to end the live, but I'll stay on for a bit. Okay, end stream.